Thursday, October 4th, 2018, Monaco 64, home of alternative economics and contrarian views. I was going to talk about COMEX this morning, but I've looked at the bond market and I'm going to talk about the bond market because it's quite important. I'm going to look at an article from Fortune magazine from February 3rd, 2013, and it's entitled Great Bond Massacre, Fortune 1994 in brackets, and the editor says, every Sunday Fortune publishes a story from our magazine archives. Back in 1994, the magazine covered the more than $1 trillion loss by bondholders. Analysts today say a similar massacre could happen soon. What we can learn from 1994's debacle. So last night I did a live stream on the bond market, like an alert. Bond yields have gone up even more since then. And I think it's really important to cover this, the bond markets, because it will affect every other market, not only in the United States, but throughout the world. Before I go into that, though, I will look at the markets. It's 8:22 a.m. London. So we've got spot gold at 11.9850, up $1.30. The range has been 11.96 to 11.99. So gold's still holding fairly well. Spot silver 14.60 up to down 2 cents. The range has been 14.55 to 14.67. So a fairly narrow range, for the precious metals. The stock market yesterday, as yields started rising, we actually saw a lot of the big gains fizzle out. I think that the Dow still finished up about 50 or 60 points. I'm not sure, but it was up almost 150 earlier. S&P and NASDAQ were actually down on the day slightly, I think, and they continue lower this morning. So the Dow is down 95 points now, or 1/3%, and that's the future. It's at 26,728. NASDAQ is down 0.5%, or 15 points at 2910, and the NASDAQ is down 50 points, or 2/3% at 7586. Currencies are fairly steady. The pound is a little stronger, up 0.2% at 129.64. Euro unchanged, 114.85. The dollar's drifted back lower against the yen. It's down 0.25% at 114.28. It rose quite a bit yesterday against the yen. That's what drove the dollar index mostly. That was what drove the dollar index mostly, the strength of the dollar against the yen. So the yuan, dollar is a little stronger, 6.89, only up 0.05% though. Crude oil continues to rise. It's still, we've got WTI above 76.15. It's down slightly from the close yesterday, 0.2%, and Brent 86 trading right now, 86.02. So crude oil not helping the financial markets, in my opinion. So what about the 10-year? Where are we right now? Well, as I speak here, my Bloomberg page says the 10-year yield's at 3.20. Yesterday when I was doing the video, I think we were around 3.15. We went up to 3.18 while I spoke. We came back down after I finished my live stream, and we got down to 3.15. And so we're now at 3.20, and we've even been as high as 3.23 today. So it's moving quickly, the bond yields, and I'll go briefly over why it's important. Well, the Treasury, U.S. Treasury is the safe haven space for bonds. Bond prices determine interest rates or yields, and those interest rates or yields are the cost of money, cost of borrowing, and the reason why the United States Treasury is the safest place for investors is that the government can print the money to pay creditors off. But that's why you got inflation. Well, they can print it. Corporations, individuals can't. So that's why let's say when the 10-year yield goes up maybe 10 basis points, maybe mortgage rates will go up 15. Corporate bonds, higher risky instruments or securities, it will go up even more. So that's the problem in a debt-fueled economy, especially of late, as we've seen. Congress and the administration spend like drunken sailors. That is a huge problem. And also for the general economy. People think the economy is great, stock market is great, they feel healthy. It's not, their portfolios are going up in value. Oh, let's buy that, put it on the credit card. It doesn't matter, our portfolio is going up. That's the problem, you see, with rising interest rates. And I'll show you a chart of why it's so significant right now, where the 10-year yield is. I mean, we are at 7-year highs. And here's the chart. I mean, if this was something else, you're looking at a commodity, you would say, wow, this looks really bullish. We've broken through 4-year highs. To this chart here, the next target looks to me to be 377, which was the high in February of 2011. So we're definitely, there's definitely something going on. You can see how it's spiking right now. You see the Federal Reserve, the financial markets, and the powers that be, they're okay if interest rates rise gradually. But when you get this, there could be a lot of accidents. And then I'll show you that through that article from Fortune magazine. The other point that I like to make is that the Fed now is in a box or against the wall. It's cornered because it's saying that it's going to sell 600 billion worth of treasuries this coming fiscal year. It's going to keep raising rates. So this could become a real problem. And how come the Fed didn't see this? They're supposed to be all the PhD economists. Well, my opinion is that they couldn't see that because they are in uncharted waters. Prior to the Fed starting, tightening, rates were at zero for over 7 years. They printed trillions and trillions upon trillions to buy bonds and other securities. And it had never been done before in the past. And not only the Federal Reserve, but all other central banks as well were involved and are still involved. I mean, the Swiss Central Bank has negative interest rates, ECB has negative interest rates, and are still doing QE. So the Fortune magazine story. So here we go, because I spoke about that because I was working in the markets already back in '94, and bonds were my specialty. I was a futures and options broker, and the bulk of my business at the time were government bonds, treasuries, Bunds, the German Bunds, Italian BTP futures, French Notional futures. We could trade all these different futures. Now it's mostly just treasuries and Bunds, because Bund is the benchmark for the euro area. Back then, there were different currencies in Europe, and also the gilt market. Back then, the gilt market was a bit exclusive. You had what they called gilt-edged market makers. So not everyone was involved in the gilt market. It was a very closed shop. So the Great Bond Massacre. So in this article, which I'll go through, Fortune magazine publishes a story back from 1994. So the Great Bond Massacre. So I'll read through it, some of the interesting points and pertinent points for today. So I'm quoting this, of course. Wasn't this supposed to be the year Alan Greenspan, while he was the Fed chairman back then, got to triumphantly parade down Wall Street to the cheers of bondholders, big and small? In many ways, the circumstances seemed right. In January 1994, the 34th month of economic expansion, bond yields were historically low, and inflation seemed negligible. Does that sound familiar? Economy doing really well, low unemployment, low inflation. Wages were going nowhere, and companies dared not raise prices. But within 7 short months of that promising start, something fairly unusual happened. 1994 became the year of the worst bond market loss in history. I'll continue. Since the Federal Reserve began nudging short-term interest rates higher in early February 1994, the bond market has inflicted heavy damage on financial companies, hedge funds, bond mutual funds. Fortune estimates that the rise in the 30-year Treasury rates, wait for this, from 6.2. Some of you maybe don't believe me when I say that 6% rates are normal. This is the 30-year. Back then, the 30-year was a bit more important, but the 10-year now is the most important one. The 30-year Treasury rates from 6.2% at the start of the year to 7.75% in mid-September has knocked more than $600 billion off the value of U.S. bonds. And this is, some of the losers are shown below. So nowadays, the financial markets have mushroomed. Can you imagine what the losses will be when, if this massacre, nascent massacre, in my opinion, continues? And with long-term rates rising in every major country, so there you go, it affects every other country. The worldwide decline in bond values, this year figures to be on the order of 1.5 trillion. I mean, multiply that by 10, maybe a bit more, for nowadays. That's assuming that rates rise no further from here, hardly a certainty. Part of the reason for such staggering losses is the sheer size of today's bond market. While this was in 1994, the size nowadays is even more humongous, right? As corporations and financial institutions securitize an increasingly large share of the American financial pie, securitizing, putting everything in packages. Everything from home mortgages to credit card receivables and aircraft leases winds up as a bond-like security available to investors and speculators alike. This is in 1994. It's gotten even worse now. In 1981, according to Securities Data Co., new public issues of bonds and notes, excluding treasury securities, totaled $96 billion. Last year, this was 1993, public offerings came at $1.27 trillion. I don't know what the figures are for that right now, but I would venture to say it's a lot higher. Here's how the article talks about how it started, right? The ugly chapter began in February 1994, when the Federal Reserve began boosting short-term interest rates in response to signs of a strengthening economy, as well as rising prices in the commodity markets. That sounds familiar. Oil price, strengthening economy. In a normal unleveraged environment, the unleveraged, today we're even more leveraged. The rise might have calmed inflation worries and even brought long-term rates down a bit. But instead, the initial increase of 25 basis points from 3% to 3.25%, and 3% at the time was like unheard of for many decades. It was like zero was 10 years ago. So instead, the initial increase of 25 basis points from 3% to 3.25% in the overnight Fed funds rate triggered an immediate 40 basis points increase in the 30-year Treasury rate, as leveraged bondholders were forced to quickly liquidate their positions to curtail mounting losses on their bond portfolios. By early May of this year, when the Fed funds rate raised the Fed raised the Fed funds rates 75 basis points, bond prices had plummeted and bond rates had jumped 140 basis points, or nearly 1.5 percentage points. And this is the part that I think is really interesting, because it shows how the Fed's blind right now. They've never been, had a scenario where they're coming out of a period of zero interest rates, money printing. And in 1994, it was the same thing. Of course, it wasn't zero rate. So the article goes to say, so how is that professional bond investors who have spent years honing their skills could have been so wrong about the possible consequences of a tightening action by the Federal Reserve? Part of the explanation lies in the Fed's late 1989 decision to push short-term rates down, not up. At the time, the federal funds rates was even higher than the long-term bond rate of 8%. So bond rates at 8%. But by the end of 1992, the federal funds rate had been brought all the way down to 3%, while long bonds were still yielding more than 7.5%. The widespread effectively created an easy opportunity for banks, security dealers, hedge funds, and wealthy individuals to profit by borrowing short-term funds and buying long-term securities. This practice came to be known as the carry trade. The term carry trade refers to the spread between what an investor pays for short-term borrowings and what he collects on long-term assets. So that's the problem there as well. The carry trade nowadays is done through borrowing, the banks do it from borrowing in different currencies like the yen or the euro, or they can do it from borrowing even from the Fed, even if it's at 2%. If they're getting 3% in the treasuries, that's still, and they leverage themselves, that's still something that will make them a profit. So very similar situation. How it all end, I don't know, but we could see a lot of accidents in the financial sector right now. That's why it's so important to keep an eye on the bond markets. So right now, as I finish this video, let's see where we are. 320 still. So it's still early doors. Tomorrow we've got non-farm payrolls as well. But it definitely seems like another bond massacre could be on the way. So Italy's still out there, but it looks like maybe the black swan could be this U.S. Treasury route. Maybe a new bond market massacre that could affect the whole financial sector, not only in the U.S. but worldwide. Look at how in 1994, when the system was a lot less leveraged, that caused a great deal of turmoil. You had the Mexican tequila crisis. You had Orange County in California go bust as well because of derivatives. You multiply that to the power of 10 for today, and you can see why it's a huge problem. If you enjoyed this video, please like, share it, subscribe to my channel if you haven't yet. You can also follow me on Steemit, DTube, Twitter, and I'll talk to you later. Take care. Bye.